The Plaza Accord has attained this sort of iconic status among international economists, in part because it was so unique as a historical example of effective international coordination, right? So not only was it coordinated intervention, but it was extremely effective. And so when I think about what made the Plaza Accord unique, is first of all, it lasted. So it did impact the dollar. So there's a 10 to 12% initial depreciation of the dollar immediately in the couple of weeks after the Plaza Accord. So within the time frame that they expected. But then the dollar continues to decline for a further 2 years, and it declines somewhere between 30 and 50% across those 2 years, depending on when you pick your starting points and your end points, right? Whereas most agreements tend, for international coordination, tend to fall apart after just a month or two. So it worked in the sense that it achieved its depreciation, but it also worked in the sense that the US trade balance was able to adjust. So we had a huge trade deficit, at least huge by those times, the standards of the 1980s. But by 1991, after you had time for the exchange rate adjustment to finish adjusting for 2 years, and then a further time for the J-curve effect to impact, the US trade balance by 1991 was basically in balance. And whereas in contrast, most other coordinated interventions really have very little lasting impact. Right? And then thirdly, it's unique because it inspired, after the Plaza Accord, I think the finance ministers were so enamored of their success with the Plaza Accord in bringing down the dollar that it spawned this 2 to 4 year period of really intense international coordination. So after the Plaza Accord, you had the Tokyo Summit, where they agreed on macroeconomic indicators. Then you had the Louvre Accord with exchange rate bands that they tried to defend. And the degree of coordination really went at least into 1988, if not further. And it's really rare when you look at efforts for coordinated intervention to have found this anywhere. Any other time that it was truly quite so successful. So then the point of the paper really is to think about whether coordinated intervention is something that could happen again today. And so what I'd like to do is sort of explore the Plaza Accord and what made it unique, in part to understand whether we can expect anything like the Plaza Accord to happen again. So there's a lot of theories about why the Plaza Accord was unique. One was that there was this big surprise involved in the US shifting its policy from committed non-intervention to now allowing some more active approach to managing the dollar. There also was an extremely strong protectionist sentiment that was coming out of the US Congress at the time. So that gave some motivation for the non-US participants to agree to strengthening their currency, in the sense that they wanted to avoid Congress slapping protectionist measures on them. The hypotheses that we explore are two. One is that the dollar misalignment in 1985 was greater than at any time since 1973. Not just against a single currency, but it was a misalignment against many currencies at once. And then the second hypothesis is that domestic monetary policy backed up the intervention that was undertaken by the three main countries uniquely at that time. In other words, that there was an alignment that monetary policy would have been supportive of the intervention at that point in time. And so what I look at, in the paper we look at all of the G5 countries or the G7 countries, but for this part we're really going to focus just on the dollar, the yen, and the mark, which were the key currencies at the time. So this is the nominal exchange rates, just to kind of give you the lay of the land of what was happening, and then on into the present. And you can see that the mark, and here we splice in the euro at the appropriate point. The mark was extremely overvalued at that time relative to really any time in the floating rate period. You do have, sorry, not overvalued, undervalued in this case. And so you do have this period right at the formation of the euro, where the euro had gotten very weak, but nowhere near as weak as the mark had become in early 1985. Now, I'll also point out that the mark starts to come down about 6 months before the Plaza Accord. And so this is something that people who look at the impact of the Plaza Accord spend a lot of time puzzling about, is whether the Plaza Accord actually mattered at all in a historical sense, because the decline had already begun back in March of 1985. And then you look at the current period, and you see that while the euro is weak at the moment, it's nowhere near as weak as it was purely by the nominal exchange rate. Now, for the yen, the Plaza Accord doesn't stick out as a period where it was especially weak. It had really been in the range that it had had for quite a while, and it wasn't until the Plaza Accord came that the yen got very, very strong, and so it appears in nominal terms to be just this step function. Now, what we want to do is to come up with a better sense of misalignment than just nominal exchange rates. So we're going to look at the real exchange rate, and we're going to adjust for real interest rate differentials. And so you can do this in a very sophisticated fashion. We took a relatively simple approach to it. And so we start with real interest rate parity. The key thing with real interest rate parity is that you have this expected real exchange rate change term, and so you need to have some way to estimate what's the value of that expected future exchange rate. And so what we do is we take what some people have called the standard assumption, which is assuming relative PPP. So we assume the real exchange rate is constant in the long run. So what that means is that future exchange rate term is just a constant, and so you can bring it over and have it just be the constant in the equation. And so what we do is we estimate just the real exchange rate against the real interest rate differential with standard OLS, and then the residuals are going to give us our estimate of fundamental misalignment. And so with the mark, it doesn't change the picture a tremendous amount. You still see this, this period of strong misalignment in the Plaza Accord period. It does make the period around the formation of the yen also stick out as a period of particular misalignment. Not quite on the same level, but it's still, it's certainly more dramatic than what you see with nominal exchange rates. You do see this period starting to develop in the current period, but it would, if at current rates of appreciation, it would take another 2 years of appreciation before you see the euro looking anywhere near as misaligned as it did in 1985. For the yen, you get a little bit more peakiness here, not a whole lot more. So the process, you do see in 1975 and 1982 a period when the yen was equally misaligned, or perhaps even more misaligned. But 1985 does stick out as a period of particular yen misalignment. You have this period in 1995 when the yen had gotten extraordinarily strong. In fact, it was more misaligned in 1995 than it was at the time of the Plaza Accord. Now, in 1995 and in 2000, here, these were periods that attracted coordinated exchange rate intervention. And so it is the case that when you see periods of large misalignment, you do see exchange rate intervention. The difference, though, this is not a sufficient condition because these periods of coordinated intervention didn't turn out to be extremely effective. I mean, the currency did move back towards its mean value or its trend value, but the timing of the exchange rate intervention relative to the reversal of the trend in the exchange rate wouldn't suggest that the intervention had actually done anything. Now, the misalignment for the yen today is much closer to the level of misalignment that we see in the period of the Plaza Accord, right? So at the current rate of appreciation, it's sort of, I don't know what you would say today, but a couple of months ago, the yen had sort of reversed itself a little bit, but if you take the longer trend here, it would only take about 3 to 6 months of further appreciation at that trend before you hit the level of misalignment that we saw in 1985. So the second question then is, was intervention consistent with monetary policy? So there's not a lot of good solid evidence in general that exchange rate intervention works among major currencies. But one factor that's that's found fairly consistently to help make intervention more effective is when intervention is done consistently with monetary policy, right? And so what that means is that tightening monetary policy is going to be consistent with exchange rate intervention to strengthen your currency. And then the key question is, how do we know which way monetary policy is headed at the time of intervention? So you need to have some sort of a benchmark, whether it's a forecast or something, to indicate whether folks would interpret your intervention as being consistent with monetary policy. So the benchmark that we're going to use is a Taylor rule. And so we don't estimate our Taylor rule, we take the Taylor rule as given from the original specification. So we just have this is the sort of the reduced form of the original specification of the Taylor rule. We do this because we want to compare monetary policy to a benchmark, and so it doesn't make sense to estimate a Taylor rule that matches monetary policy and then compare monetary policy to it. So for us, it's more important to use the imposed Taylor rule. And we construct these Taylor rules for the US, for Japan, and Germany. We're careful to use real-time data because it's important to look at what is the decision, what would markets or other decision makers have thought at the time of the intervention. For inflation, we use real-time inflation numbers. For the output gap, we have the actual output gap numbers that the central bank was using for Germany. For US and Japan, we use a quadratic detrending to determine the output gap, which my co-authors really prefer for the US. And for Japan, we looked at it, and I don't think anybody else has done a quadratic detrending for an output gap in Japan. But when we compared it to other methods, we really thought that was the best way to go. And so then what we say is that a gap between the actual interest rate and the Taylor rule indicates policy space where the central bank can intervene to move, where the central bank can move towards the Taylor rule, and then that would be interpreted as being consistent or inconsistent with exchange rate intervention. So when you look at the US, what you would say is that when the interest rates are above the Taylor rule, then that gives them policy space to loosen monetary policy. And so for the entire period of the mid-1980s, the US exhibits this measure of policy space to loosen monetary policy. And of course, you'll remember that the US was coming out of very high inflation in the late 70s and early 80s, and Paul Volcker was a central bank governor and was the Fed chair, and so interest rates were very high relative to what the Taylor rule suggested in this period. So now we get to the question of whether intervention was consistent with monetary policy. And so what we would want to see is whether the US has policy space to loosen, and so that would bring down the dollar in that period. And then do Germany and Japan have policy space to tighten relative to the Taylor rule, and that would be consistent with exchange rate intervention to strengthen the mark in the yen. And so I've shaded here the time of the Plaza Accord. And so you can see that indeed the US did have policy space to loosen, so that the federal funds rate would have declined in order to move towards a Taylor rule. For Germany, if you can see these lines very well, Germany and Japan, however, line up exactly the same as the US. They were running rates that were higher than what the Taylor rule would have suggested for both countries. So what that essentially means is that there was not this unique confluence of consistency with monetary policy to the extent that our measure of consistency is an appropriate one. Now, it's also interesting to think about why it is that all three countries were in this situation where all three countries had tight monetary policy. And my speculation is that the US was the leader in this case, that Volcker's high interest rates were causing problems for both Germany and Japan, and so both central banks had to have interest rates that were higher than what they wanted at the time because of what was going on in the US. So that sort of ties in with some of the other papers that we've seen here. Now, Another thing that you could look at is how often is it that you see this confluence of consistency of monetary policy, and of course then you could ask whether that causes whether you see exchange rate intervention in the direction in which monetary policy that would be consistent with monetary policy at a time when it's consistent. Essentially, you see the Taylor rule deviations here, where a positive deviation would be consistent with an intervention to strengthen the dollar. And I've shaded with a black outline the times when all three countries have monetary policy that's in alignment with moving the dollar either upward or downward. There's not a single period from 1997 to 2007 when there's alignment in any major way to weaken the dollar, but there were several periods when there was alignment to strengthen the dollar. And so you saw in 1995, when the yen had gotten so strong, that around that time it was plausible that you would have exchange rate intervention to strengthen the dollar, and indeed there was a fair amount of intervention in this period. But in general, there's not very good consistency between the timing of intervention and consistency of monetary policy. So to the extent that you buy my measure of consistency of monetary policy, it doesn't appear that the authorities are paying a whole lot of attention to it as an indicator that it's a good time for intervention. So I think the interpretation is then that the U.S. was the main story at the Plaza Accord. The U.S. was the only country whose monetary policy was going to be consistently, could be interpreted as consistent with the intervention that took place in the Plaza Accord. And of course, along with monetary policy consistency, it had the two other big factors going along, which is that it had the big surprise factor that they were changing their exchange rate management regime, and that they were motivated by that there was this internal protectionist dynamic that was going on. Now, of course, it's possible that the markets believe that Japan and Germany consider their exchange rate as an important factor in driving monetary policy, and there's some evidence that if you estimate Taylor rules, that real exchange rate terms are significant in those the work that other folks have done. So maybe the Taylor rule for these two countries need an exchange rate term, and therefore it was credible that they would intervene to support this to support the Plaza Accord. Or that monetary policy would support the Plaza Accord because monetary policy was targeting exchange rates as well as domestic factors. Of course, it's also possible that the Plaza had no effect whatsoever, that the exchange rate was already declining, and all they were doing was putting extra speed on a rock that was already falling downhill. So I can't claim that our evidence is necessarily consistent. Now, we turn to today. There are some similarities to the Plaza Accord. So the dollar is certainly strong again. It's stronger against some currencies than against others, but it's not quite as strong as it was relative to the time of the Plaza Accord. On the other hand, it's pretty clear that none of the central banks, the ECB, the Bank of Japan, or the Fed, are likely to engage in monetary policy that would be supportive of bringing the dollar down, right? If anything, we're moving in the other direction very soon. And the last thing that I would point out is that the protectionist momentum at the moment is a whole lot lower than it was in 1985. In 1985, there really was concern that there would be lots of very directed protectionism, especially towards Japan, but also more broadly. Right now, Congress seems to be more focused on the trade agenda, on currency manipulation, which is a much more disciplined approach. That they only want to engage new protectionist measures against countries that are actively manipulating their currency. However, the dollar is very strong, and so with J-curve effects, it could be only another year, year and a half before you see the US trade balance start to deteriorate quite considerably, in which case Congress does tend to predictably get more ornery about protectionism. So this may be a situation where if the dollar stays strong for another year or two, you may start to see the fear of protectionism start to motivate some of these countries like Japan and Europe to start thinking about, well, maybe we should help bring the dollar down to reduce the protectionist pressures. But the bottom line is that at least in the near term, we don't need to worry about fear of. We don't need to think about the Plaza Accord. There's no momentum towards a new Plaza Accord. Thanks.
I actually have very, very little to say about this paper. I enjoyed it a lot. I'll just spend a couple of minutes on the paper itself, and then I'd like to spend a few minutes talking about policy coordination more generally. So the authors argue that Plaza was a unique confluence of events and opportunities. There was widespread agreement among trading partners as well as the general public that the dollar had become overvalued. There was a philosophical shift from the first Reagan administration under Don Regan, and then when James Baker came in with a much more pragmatic and less ideological point of view about the possibility of doing intervention. Incidentally, when Don Regan was the Treasury Secretary and he said, we will never intervene in the foreign exchange markets, a few weeks later, President Reagan was shot and the US Treasury promptly intervened in the foreign exchange market. That was hopefully a unique event. And the authors argue that the direction of sterilized intervention was consistent with monetary policy, and that might be one of the reasons why it was so successful. In fact, it was probably overly successful because by the time of the Louvre Accord, they were intervening in order to support the dollar. Okay. Just as you want to say that. So the part of the paper which I found less convincing was this estimate of the overvaluation of the dollar. So as Russell pointed out, they basically use the interest arbitrage condition. They assume that the future expected real exchange rate is 0, and then they get a kind of fitted value for the real exchange rate, and the deviation from that is what they call overvaluation. And the way the paper writes it is that a higher real interest rate strengthens the real exchange rate. That's true, but really if you go back to the arbitrage condition, a higher real interest rate means that the market expects a depreciation. Now, it may be that they expect a depreciation because the level is too high. So that's one way of squaring the circle. But really, when you look at this picture, it's pretty darn obvious that the dollar was overvalued at this point. Right? So either you might want to just assert that, or look at things like the trade balance and the NFA stabilizing trade balance and sort of use one of those more economic arguments in a sense for overvaluation. The second leg on which the paper stands is that they go back and estimate Taylor rules, or they actually impose a Taylor rule, I guess before Taylor actually invented his rule, but you've gone back in history and work out what the interest rate should have been under a Taylor rule. And for the dollar, the Taylor rule implied interest rate was around here. The actual interest rate was there. And so there was scope for loosening US monetary policy, which would have gone in the direction of depreciating the dollar. And hence the intervention might be signaling that the monetary policy would be expanded, and therefore it supported the depreciation. So I can stop my comments right here. I like the paper a lot. if I have 5 minutes, I'll talk about policy coordination more generally. Okay. So Plaza is often taken as a very successful case of policy coordination, but I'm not sure it was policy coordination in the sense that economists use the term. So it was coordinated intervention. So in the normal English usage of the word, it was certainly coordinated. These central banks, or the central banks that corresponded to the finance ministries, did intervene at the same time in the same direction. So it was coordinated. But it's not really policy coordination, which requires that countries have some conflict in their objectives and that they have fewer instruments than targets. I would argue that at Plaza, there was widespread agreement of which way the dollar was meant to go. For kind of diplomatic language, in fact, the way it was expressed was appreciation of the non-dollar currencies rather than depreciation of the dollar. But there was agreement on which direction this is meant to go. The policy coordination, I mean, the fundamental economics of it is that there are spillovers or there are public goods or public bads related to macroeconomic policies, and unilateral policy making results in inefficient or Pareto inefficient outcomes. Okay. Under some very mild conditions, the Nash equilibrium is going to be inefficient. What are those conditions? It's about having fewer instruments than targets, and there's what I call a comparative advantage condition, which I'll explain in a moment. But in policymaking discussions, you often hear all of this as, well, you know, for example, the Fed's mandate is a domestic mandate, and therefore we can't take into account the effects of emerging markets of doing QE. Okay? But policy coordination is not at all about doing a favor or being altruistic to others. It's about maximizing your own self-interest, but by doing it in a coordinated way, both parties are better off. So why don't we see more policy coordination? And I would argue that there are three reasons. First is a failure to recognize policy trade-offs. So what coordination is about each country getting a different trade-off between its own objectives. So it may be unemployment and inflation, or financial stability and expansion. There is a trade-off there. And all policy coordination does is that it allows you to achieve a different trade-off, ultimately a better trade-off between your two objectives. But if you only have one objective, then there is no trade-off, and therefore there can be no policy coordination. And what tends to happen is that policymakers tend to focus on one objective at any particular moment. So during the crisis, of course, you're worrying about unemployment. Okay? You're not worrying about financial stability risks that might come down the road as a result of all the monetary expansion you're doing right now. And because policymakers often tend to focus on one objective at a time, or the institution that's in charge of for example, the Fed actually has two mandates, but in most central banks have essentially one mandate, and so they can't make these trade-offs by their own mandate. The analytics of policy coordination, just ignore the equations, are that you have some trade-off between your two objectives, Y1 and Y2, and this is your indifference curve between them. And the Nash equilibrium involves going from some initial shock and finding the tangency. Under coordination, you basically get to trade along the world trade-off line, and you get a higher level of welfare. Now, since almost every economist agrees on the analytics of the gains from free trade, it's sort of a mystery that we don't see more coordination in practice. So I've explained one reason why. The second reason that's often brought up is uncertainty about the effects of policies. Okay? and this is often the sort of major obstacle to successful policy coordination. What one can show analytically is that uncertainty about the effects of policies actually raises the gains from coordination. And one way to think about that is that when there's uncertainty about the effects of my policies, I automatically have more targets than instruments, because I now care about the average level of my target plus the volatility. And so I'm automatically going to have a greater incentive to coordinate. And second, the foreign partner, as he uses his policy, he's adding to the volatility around my targets. And so there's a bigger spillover from him to me automatically once you have model uncertainty. So actually, uncertainty raises the gains from coordination. The reason it makes coordination more difficult to achieve is that both sides now have an incentive to misrepresent their beliefs about the true model. Okay? So I'm going to say, well, the negative spillovers from my policies are actually very small, and you're going to say they're very large, and vice versa. So you can sort of set this up as a game theory, a game. And if you think that if one country is cheating in the sense of misrepresenting its beliefs, it'll get caught ex post when the outcome looks very different from what you claimed it was going to be. And how you're going to punish your partner essentially by refusing to coordinate, at least for some period of time. So there'll be this kind of trigger strategy in which you autonomously end up in periods in which you cannot coordinate because you have to punish your partner for having cheated. Now, of course, by construction, he will never have cheated because the way the game was set up, he won't actually have the incentive to cheat, but you still have to punish him when there's stochastic realizations that happen that way. And arguably, the sort of 1978-79 Bonn summit was one such case. Essentially, the US, Japan, Germany agreed on the locomotive theory, where the US was going to reduce its budget deficit. Japan and Germany were going to do some expansionary policies. And then just when they'd agreed to all that, they got hit by the 1979 oil shock. And Japan and Germany got a bit disenchanted with the idea of policy coordination, not really because they thought the US had cheated in its views about what the evolution was going to be. Nobody knew that 79 oil shock was going to come. But you then have this period of no coordination until Plaza, when they come back, I would say not really in policy coordination, but at least cooperating in undertaking sterilized intervention in a coordinated way. Again, in my view, a fascinating episode. There's a superb book by a journalist called Funabashi. He wrote this book in 1986-87, and it's the inside story. And maybe at the James Baker Center, you'll be doing some more work on telling us about what happened behind the scenes. But very enjoyable paper. Thanks.